On May 6, 2010 at 2:45 p.m., the Dow Jones plummeted 600 points in 5 minutes. Traders watched their screens freeze. Orders executed at a penny per share for companies worth billions. Then, just as suddenly, the market snapped back. The entire collapse and recovery took 36 minutes. Investigators later discovered that no human made the decision to sell. No hedge fund manager panicked. No CEO dumped shares. The crash was executed entirely by algorithms trading against other algorithms, moving faster than any human could comprehend, creating a feedback loop of machine panic that erased $1 trillion before anyone understood what was happening. That was 2010. The algorithms were primitive compared to what runs the markets today. Back then, they followed simple rules. If price drops, sell. Now, artificial intelligence systems don't just follow rules. They predict market movements, model risk across thousands of assets simultaneously, and make allocation decisions for $18 trillion in capital without waiting for human approval. These systems operate in complete silence. No press releases, no trading floor, no visible moment when the decision gets made. The largest asset managers in the world have handed control to AI platforms that most people have never heard of, and the fragility that caused the flash crash hasn't been fixed. It's been amplified by machines smart enough to panic in ways we can't predict. BlackRock manages $10 trillion in assets. That's more than the GDP of every country except the United States and China. Vanguard manages $8 trillion. State Street manages $4 trillion. Together, these three firms control roughly $22 trillion, which represents nearly a third of global stock market value. They didn't build that empire on human intuition. They built it on a system called Aladdin. Aladdin stands for Asset, Liability, Debt, and Derivative Investment Network. BlackRock developed it in 1988, originally as an internal risk management tool. Over 3 decades, it evolved into something far more consequential. Today, Aladdin doesn't just manage BlackRock's $10 trillion. It's licensed to over 200 institutional investors, including pension funds, insurance companies, central banks, and sovereign wealth funds. Those external clients add another $8 trillion to the platform. That means Aladdin monitors and influences the allocation of $18 trillion in global capital. The platform operates through 5,000 computers running 24 hours a day, processing data from every major market on Earth. It tracks millions of securities, bonds, derivatives, and alternative assets in real time. Every night, Aladdin runs 200 million risk calculations, stress testing portfolios against thousands of hypothetical scenarios, interest rate shocks, currency crashes, commodity spikes, geopolitical crises. The system doesn't ask permission. It identifies risk, models the optimal reallocation, and either executes trades automatically or presents recommendations that clients almost always accept. What makes Aladdin different from the simple algorithms that caused the flash crash is machine learning. The 2010 crash was triggered by dumb automation, an algorithm programmed to sell based purely on volume, ignoring price. Aladdin uses AI models trained on decades of market data to make predictive judgments. It doesn't just react to price changes, it anticipates them. If Aladdin's models detect systemic stress, rising default probabilities, liquidity contraction, correlation spikes, it begins reallocating capital before the crisis becomes visible to human analysts. This is why $18 trillion moves without headlines. The decision happens in the invisible layer where algorithms communicate with other algorithms. The problem is that Aladdin isn't alone. Competing platforms run by firms like State Street use similar AI models trained on similar data. During calm markets, this competition is efficient. During stress, it becomes catastrophic. If multiple AI systems detect the same risk signal and independently conclude they must sell the same assets, you don't get a measured, rational market adjustment. You get a synchronized stampede. The flash crash revealed a design flaw that hasn't been fixed. Markets optimized for speed are structurally fragile. In 2010, high-frequency trading firms accounted for 70% of U.S. equity volume. Their algorithms were programmed with a single priority: minimize risk by exiting positions the instant volatility appeared. This made sense for each individual firm. Holding inventory during a price drop means losses. The rational choice was to sell immediately. But when thousands of algorithms made the same rational choice simultaneously, rationality became collective panic. High-frequency traders didn't stabilize prices by buying the dip. They amplified the crash by competing to sell first. In 14 seconds, 27,000 E-mini futures contracts changed hands between HFT firms, passing the same positions back and forth like a hot potato. Only 200 of those trades involved actual buyers who intended to hold the contracts. The rest was machines trying to dump inventory onto other machines. The crash demonstrated what engineers call tight coupling, when components in a system are so interconnected that a failure in one part instantly propagates everywhere else. The institutional sell order hit the futures market. Arbitrage algorithms detected the price gap between futures and equities. They bought cheap futures and sold the underlying stocks, transmitting the panic from Chicago to New York in microseconds. By 2:45 p.m., liquidity providers withdrew entirely. With no genuine buyers, market orders executed against stub quotes, placeholder prices that market makers post at absurd levels, sometimes a penny, sometimes $100,000, just to technically meet quoting obligations. Procter & Gamble, a company worth $60 per share, traded at 1 cent. Regulators responded by implementing circuit breakers, automatic pauses that halt trading when prices move too fast. The limit up limit. Down mechanism prevents trades outside a narrow price band. Market-wide circuit breakers stop the entire market during severe declines. These safeguards address the 2010 failure mode. They don't address the next one. The AI systems managing $18 trillion today are exponentially more complex than the simple HFT algorithms of 2010. They don't follow hard-coded rules. They use machine learning models that adapt based on new data, identifying patterns and correlations that human analysts never programmed explicitly. This makes their behavior fundamentally unpredictable under extreme stress. A circuit breaker might pause trading, but it doesn't stop AI models from independently concluding that the optimal strategy is to sell everything the instant trading resumes. Professor Andrew Lowe at MIT has been studying algorithmic market dynamics since the flash crash. His research identified a pattern that should terrify anyone with a retirement account. During the market disruption in March 2020, when COVID lockdowns triggered global panic, Lowe's team documented synchronized losses among AI-driven investment models. Multiple platforms, using similar machine learning techniques trained on similar historical data, reached similar conclusions about risk and executed similar reallocation strategies at similar times. This is the nightmare scenario embedded in the $18 trillion infrastructure. AI models don't need to communicate or conspire to move in lockstep. They just need to see the same data and draw the same rational conclusions. If Aladdin's risk models detect stress in corporate bond markets and recommend rotating out of credit into cash, and State Street's competing AI system detects the same stress and makes the same recommendation, and every pension fund and sovereign wealth fund using these platforms accepts the guidance simultaneously, the resulting sell pressure doesn't just move prices. It breaks markets. The scale is what makes this different from 2010. The flash crash involved HFT firms with no long-term positions, trading for fractions of a cent on millions of transactions. The $18 trillion managed by AI platforms represents real capital, retirement savings, insurance reserves, endowment funds, sovereign wealth. When that capital moves, it doesn't just cause temporary volatility. It forces liquidations, triggers margin calls, and destroys balance sheets. Worse, the systems are opaque. BlackRock doesn't publish Aladdin's source code. Clients don't know exactly how the AI models weigh different risk factors or what correlations they've learned from historical data. Regulators don't have access to stress test the platforms under hypothetical crisis scenarios. The entire $18 trillion edifice operates on trust. Trust that BlackRock's engineers designed Aladdin conservatively. Trust that competing platforms won't all panic simultaneously. Trust that circuit breakers will contain any cascade. That trust is misplaced. The 2010 crash proved that systems optimized for efficiency under normal conditions become catastrophically unstable under stress. AI amplifies this dynamic because the models are constantly learning, adapting, and recalibrating based on new information. They're designed to be predictive, which means they're designed to act before humans recognize a problem. This speed advantage, marketed as a feature, is the structural flaw that guarantees the next crisis. There's a paradox buried in the design of these systems. AI platforms are trusted to manage $18 trillion because they're faster and more comprehensive than human judgment. They monitor thousands of variables, process millions of data points, and execute decisions in milliseconds. But when the system behaves in a way that contradicts human intuition, when Aladdin recommends selling assets that look fundamentally sound, or rotating into positions that seem risky, the human instinct is to intervene. Every major AI platform has a kill switch, a manual override that allows operators to shut down automated trading and take back control. This seems prudent. It's the safety valve that ensures humans remain in the loop. The problem is that kill switches are only useful if the operator understands what's happening and knows the correct response. During the flash crash, traders didn't understand what was happening. They saw prices collapsing with no obvious catalyst and no clear bottom. The instinct was to pull back, stop trading, and wait for clarity. That instinct, multiplied across hundreds of firms, accelerated the crash. When liquidity providers withdrew, the decline steepened. When the withdrawal was interpreted by algorithms as confirmation of systemic failure, the panic intensified. The rational individual choice, step back and avoid losses, became collective disaster. The kill switch dilemma scales with AI. If a synchronized sell-off begins across $18 trillion in assets, and portfolio managers at pension funds and sovereign wealth funds see their holdings plummeting with no clear explanation, they will reach for the override. They will shut down Aladdin's automated reallocations and try to stabilize manually. But if hundreds of operators hit their kill switches simultaneously, the resulting liquidity vacuum will be worse than any algorithmic panic. The machines won't be selling anymore, but the markets will still be collapsing because there are no buyers. This creates an impossible choice. Trust the AI to navigate the crisis, even when its logic seems insane, or take back control, knowing that the manual intervention will trigger the very collapse you're trying to prevent. The 2010 crash lasted 36 minutes because automated systems paused briefly, allowing prices to stabilize. The next crisis, involving $18 trillion managed by AI, too complex to understand and too fast to override safely, might not stabilize at all. After the flash crash, regulators needed a villain. The official report from the SEC and CFTC identified the institutional sell order from Waddell and Reed as the trigger and the subsequent HFT withdrawal as the amplifier. But that explanation was too systemic, too abstract. It didn't offer the satisfying moral closure that comes from prosecuting a criminal. In 2015, British authorities arrested Navinder Singh Sarao, a day trader operating from his childhood bedroom in Hounslow, West London. Sarao was charged with 22 counts of fraud and market manipulation, including contributing to the flash crash. His crime was spoofing, placing large fake orders to trick other traders and algorithms into moving prices, then canceling the orders before execution. Prosecutors claimed he made $70 million using this technique. Sarao's profile was unusual. He was diagnosed with Asperger's syndrome. He described himself as addicted to trading, driven by compulsion rather than greed. Despite his alleged profits, he lived frugally, drove a modest car, and used coupons for groceries. He eventually lost over $40 million in fraudulent investment schemes, demonstrating a profound disconnection between his trading success and any real-world benefit. The prosecution acknowledged he wasn't motivated by typical greed. The judge noted his extraordinary cooperation with regulators, helping them understand how others exploited systemic vulnerabilities. Sarao faced 380 years in prison, but was sentenced to 1 year of home confinement, mostly time served. He paid $12.8 million in forfeiture and walked free. The Sarao prosecution revealed the moral incoherence at the heart of modern financial regulation. Spoofing is illegal because it manipulates price discovery through false signals. But the entire high-frequency trading ecosystem relies on algorithms interpreting signals in the order book and reacting faster than humans can comprehend. The system is designed to be manipulated by speed. Sarau's crime was doing manually what AI platforms do automatically, exploiting the assumption that large orders reflect genuine supply or demand. Focusing on Sarau allowed regulators to avoid the harder question: who is responsible when the system itself, built by the largest financial institutions and blessed by regulators, panics and fails? The answer is no one, because holding institutions accountable for designing fragile markets would require admitting that the pursuit of efficiency, faster trades, lower costs, higher volumes, created existential risk. Adam Smith's invisible hand was a metaphor for how individual self-interest, mediated through market competition, produces collective benefit. Buyers and sellers, acting rationally to maximize their own outcomes, create prices that allocate resources efficiently. The invisible hand assumes that market participants are human, operating at human speed, with human judgment. The $18 trillion managed by AI platforms operates under a different logic. The hand is still invisible, but it's no longer human. Algorithms don't have self-interest. They have objective functions: maximize return, minimize risk, optimize allocation. Those objectives are programmed by humans, but the execution happens autonomously at speeds that prevent oversight. The result is a market where the invisible hand is a feedback loop of machine rationality, amplifying small signals into systemic shocks. Aladdin doesn't cause crashes by being reckless. It causes fragility by being rational. Every trade it executes, every reallocation it recommends, is justified by its models. The problem is that rationality, when scaled to $18 trillion and compressed to milliseconds, becomes indistinguishable from panic. If the models say sell, the system sells. If every competing platform's models say sell simultaneously, the market collapses, not because the AI made a mistake, but because it followed its programming perfectly. This is the fundamental difference between the 2010 crash and the future crisis that AI guarantees. The flash crash was a failure of dumb automation, an algorithm that ignored price, HFT systems that withdrew liquidity, and a market structure that allowed nonsensical trades. Regulators fixed those specific failures. But the $18 trillion infrastructure isn't dumb. It's smart. It learns. It adapts. And that intelligence makes it more dangerous, because the next cascade won't be triggered by a coding error or a fat finger trade. It will be triggered by rational predictive models independently concluding that the optimal strategy is flight. The lesson of the flash crash is that speed introduces fragility, and fragility at scale becomes systemic risk. The $18 trillion managed by AI platforms represents the largest concentration of automated decision-making in human history. It operates without transparency, without external stress testing, and without clear accountability when it fails. BlackRock's Aladdin is proprietary. Clients trust the platform because BlackRock's reputation depends on it working. But reputation isn't a safeguard against synchronized panic. During the 2008 financial crisis, institutions with stellar reputations, Lehman Brothers, Bear Stearns, AIG, collapsed because their risk models failed to account for correlations under stress. The models assumed diversification would protect them. Instead, everything declined simultaneously because the models were wrong about independence. AI platforms face the same correlation risk, magnified by speed and scale. If Aladdin's models and competing platforms' models are trained on the same historical data, they will learn similar patterns and develop similar blind spots. They will all miss the same tail risk, and when that risk materializes, they will all respond identically, creating the synchronized sell-off that regulators fear but cannot prevent. The regulatory response to 2010 was reactive. Circuit breakers, quote, reforms, position limits. These mechanisms address mechanical failures. They don't address intelligence failures. An AI model that predicts a market crash and reallocates capital preemptively isn't breaking any rule. It's doing exactly what it was designed to do. But if every AI model makes the same prediction and executes the same reallocation, the prediction becomes self-fulfilling. The solution isn't better regulation of individual algorithms. It's transparency and accountability for the platforms themselves. Regulators need access to stress-test AI models under hypothetical crises. They need to understand what correlations the models assume, what risk factors they prioritize, and what conditions would trigger mass reallocation. Most critically, they need the authority to demand that platforms build in stabilization mechanisms, requirements to maintain liquidity, limits on reallocation speed, coordination protocols to prevent synchronized panic. None of this exists today. The $18 trillion operates in a regulatory void, governed by private contracts between asset managers and their clients. The public has no visibility into how these systems work, what risks they create, or who will bear the cost when they fail. The answer to that last question is obvious. When the next crash comes, driven by AI rationality rather than human error, the losses won't be borne by BlackRock or Vanguard or State Street. They'll be borne by pension funds, retirees, insurance policyholders, and taxpayers forced to bail out the institutions that couldn't meet their obligations. The flash crash lasted 36 minutes and erased $1 trillion before stabilizing. It was a warning that markets optimized for speed are structurally fragile. The $18 trillion managed by AI platforms is the same fragility, scaled up and made opaque. The machines are smarter now. They predict crashes instead of just reacting to them. But intelligence without accountability is just faster panic. And when $18 trillion panics, there's no invisible hand to catch it. There's only the fall.